Muhami Matters with Chris Adams, powered by CJA Consulting.
In UAE, it's very complex because you have so many parallel jurisdictions. So you may be acquiring a company in a different free zone or on the mainland, and different laws would apply sometimes. People think, oh, all we need to do is carry out a financial due diligence, but they forget, and sometimes they overlook the importance of legal due diligence.
What should really buyers do to approach due diligence effectively?
So you usually have a disclosure letter, right, where all these issues are mentioned, and it should be attached to the SPA in order to protect the seller. So as long as the seller does that, it doesn't matter if the buyer had a lawyer or not, because seller has done his bit.
Welcome to Muhami Matters, the podcast where credibility meets clarity in legal and professional services across the UAE and the wider region. I'm your host, Chris Adams, founder of Muhami and CJA Consulting. Today, we're going to talk about things to look out for when buying a business. A smart acquisition can accelerate growth, but the UAE's dynamic legal landscape means due diligence isn't optional. It's a mandatory thing to do. To help us navigate these issues and work out what actually needs to be done, I'm joined by Samir Khan, founder of SK Legal, who brings over 14 years of M&A and advisory experience across domestic, DIC, and arbitration contexts. Samir, welcome. How are you today?
Hey, Chris, how are you? I'm all well. Thank you. Good to be on your platform.
Yeah, thanks for joining us. Like one of the best lawyers in the UAE, I'd say, and you're quite diverse in what you do. So, I know you've done a broad range of work, but tell us. We're going to focus on M&A today. So, tell us a bit about your background. I know you went to Oxford, for example, and what's drawn you over your career into M&A.
Okay, so basically, I've been in UAE for the last 14 years, and I've had a wide range of practice. There is a section of our firm that concentrates on M&A, but obviously we do other areas as well. Now, what I like about M&A is that M&A utilizes all of our skill sets that we develop in other areas. So, for example, when you're doing a due diligence of a company, you need to know about what the employment law of a country is, what the code procedures of the countries are. If there's like a criminal element to certain things, loan agreements, what the banking laws are, how will the contracts be affected, and the actual company law as well, how the transactions happen. So it utilizes all your, knowledge, and you have to have a wide range of knowledge over the period of time you develop that. And also in UAE, it's very complex as well because you have so many parallel jurisdictions. So you may be acquiring a company in a different free zone or on the mainland, and different laws would apply sometimes. The company's law, there's a federal company's law, but that doesn't apply to every single free zone. DIC, for example, has its own company's law. ADGM has its own company's law. So therefore, you have to have a wide range of knowledge anyway in order to properly advise a client on acquisition. And that's what makes it more interesting and challenging.
Yes, so let's start with the basics. You alluded to it just then, but could you explain what M&A transactions typically look like in the UAE?
Right. The ones that we come across a lot are basically someone from abroad comes over. He wants to shift to UAE, for example. It's like a high net worth individual. Sometimes they want to shift to UAE, and they are just going around UAE, and then they see certain businesses, or certain businesses are promoted to them. And they like those businesses because they think they are quite, good money-making ventures, lucrative businesses. And there, they would then like to take over the business rather than purchase any assets as such. That also is an element, by the way, that we do. But they would like to purchase the shares and become direct owners of the company. So that's the kind of transaction that we mainly focus on.
And so then what are the typical parties involved? I mean, that sounds like a lot of sort of inbound investment rather than, two companies that are here that decide to merge or one takes over another. It sounds like what you're seeing a lot is inbound investment from overseas.
Yeah. What we see, because a lot of high net worth individuals want to move to UAE, want to, have a good source of income from the UAE itself, rather than bringing in income from abroad all the time and living over here. They want their families to live here. They want their children to grow up here in a very safe, secure environment, very peaceful environment. And so for that purpose, if they're already high net worth individuals, they would like to purchase a business. Give you an example, on a no-names basis, we recently advised a transaction in terms of somebody wanted to purchase a very large restaurant, which is doing very well. And someone else wanted to purchase an IT consultancy, which is doing very well as well. So that's one element, what people are. Then there are, from our practice, we also find that there are already international companies where there may be a significant operations within UAE. And that's the particular transaction that we're currently working on, basically, where an international company is being purchased by another international company. And we are advising on the UAE arm of the company. So we are carrying out the due diligence for the UAE company or the UAE branch subsidiary.
Very interesting. And yeah, I think often people just think more about domestic M&A, as we've sort of alluded to, rather than that international influence. Just taking it really back to basics. So who are the typical parties involved in M&A transactions? So I guess one thing that not a lot of people who don't get involved in these kind of transactions very often don't realize that actually a lawyer, for example, is quite often right at the center and actually probably running the whole transaction, bringing all the parties together, the banks, the finances, obviously the party that's either part of the merger or the acquirer. Who else is involved? What needs to come together to get a deal started?
Okay. So what I'll do is I'll try to provide a basic framework, a step-by-step stages, what happens. Okay. Right? I will, for this example, I will leave out third-party financing, right? Okay. Which is, banks getting involved and all those kind of things, right? Let's just imagine you have a large company or a high net worth individual who does have the cash and the funds to purchase another company within UAE. So they like it for whatever reason they like, right? Now, they come over and the first step is that they start negotiating at a very high level, okay? Now, M&A could comprise of various kind of things, right? Like you can acquire various things. For example, you can acquire, like I said, a large restaurant company or a IT consultancy or even a developer who actually owns certain buildings, or you can purchase that, right? Now, let's just say a set company. So somebody has the cash and they want to purchase a company in UAE, right? The first thing would be what we call the MOU stage, which is the memorandum of understanding. Now, this is a non-binding MOU stage, where what happens is, okay, I'm here, I want to purchase this company for, let's say, 50 million dirhams, right? And you kind of talk about on a ballpark estimate of what the kind of price would be, what kind of like high level commercial terms there would be, right? But that is all provided that if you carry out the due diligence and everything is okay with the company. So it's a non-binding MOU. Now here, the lawyers have to get involved, right? Because we've got to ensure that we don't lock in the buyer to some kind of a, commitment. So it's got to be absolutely sure. And we've got to make sure various things can go wrong, which I'll explain in our, next down the lines. Right now I'm explaining. So the first thing is a non-binding MOU.
Okay.
The second stage is due diligence. So you sign an MOU, non-binding MOU. Yeah, I'll buy it if everything's good. Then the due diligence comes in. Now here, the issue, a lot that arises is that people think, all we need to do is carry out a financial due diligence. So they get their accountants and say, hey, send over your audit reports and statements and everything, and we'll take a look at it, and it all makes sense, right? But they forget, and sometimes they overlook the importance of legal due diligence, right? So what that means is somebody, the lawyer, would look at all the contracts of the company. He will look at all the employment contracts. So the lawyer will say, well, okay, so you have not committed something major in your contracts, just, some other company. There is no like a huge potential liability coming down the road. Employment contracts, you haven't got employees on huge commissions, bonus provisions, because that's something a final auditor might not be able to see from the figures. Down the road, you purchase the company, a year later, you have to give a 500,000 dirham like bonus to some of your senior management people, or $1 million dirham bonus, and that's going to take a hit on your profit, which you didn't know about. Or you may have committed supply contracts, your lease agreement. So, for example, you're purchasing a restaurant, right? And this happens a lot, okay? And this is an example that we had to deal with.
Real world, yeah.
Real world, right? So people go in and they want to purchase a restaurant or a shop or a retail unit, let's say, in a big shopping mall, right? They sometimes forget, right? They say, okay, yeah, we'll take over the company and that's it. But a lot of these lease agreements, especially under like DIC free zones, right? They have clauses where they say you have to seek permission from the landlord before you assign the lease. And change of ownership is akin to assigning a lease. And in DIC, they could easily terminate you on that basis sometimes as well. But yeah, in the mainland, there's different issues that could come across. But again, so the lawyer would be able to tell, look, you have to get these permissions as well. So not only you have to see if there's a liability or something, what permissions are required as well from the appropriate authorities or landlords in order to have a smooth transition and you don't get in trouble. Another thing that happens is a lawyer could explain that you are buying this really nice restaurant or really huge store in a shopping mall with very refurbished, looks very nice, and you're paying good money for it, right? But have you realized that your lease agreement is only for a year? Okay?
Yeah.
So all that money will go down the drain. So you got to make sure that the seller first locks in a 3-year deal or a 5-year deal, usually it's 3 years, with the actual authority. So you have some time to, make some money out of that particular restaurant or a store or whatever it is. So there's a lot that happens in due diligence. A lot. Very importantly, what we do as well in due diligence is we carry out whether there are any legal cases against the company or against the management or shareholders of the company currently, right? Which could affect the company itself, but mainly it's against the company. So we take it, and that could be a major thing as well. So that's the second stage. So we do the due diligence, make the relevant report, and then we go to the third step. So once the due diligence is okay, then the third step comes, which is a very important step, which is called the signing the share purchase agreement, the SPA.
Okay.
Right. Now, this third step is very important because what happens is, let's say I find out certain things in due diligence. There's a legal claim, for example, against the company. And the seller is saying, yeah, there's a legal claim, but it's a very weak claim. Somebody just filed a claim against us and it doesn't make any sense and it's all wrong, false and everything. But there's a claim in the court, right? So in the SPA, again, a lot of people just saying, yeah, SPA is okay, we all agree, we buy these shares at this time, at this date, for this money, that's it. But no, you have to protect the buyer. So you have to put in certain kind of indemnities from the seller saying, oh, well, if this particular case, if you end up paying money, then I will compensate you for it. Or we will indemnify you. Something like that. Again, the seller needs to be protected. All the kind of what we call the red flags that arise in due diligence that are then are addressed in the SPA. And that due diligence also helps a lot in terms of getting the parties to negotiate the price further, right? So, for example, I come in big, like I love this big, like, let's go back to the restaurant example or a store example, right? In a particular nice shopping mall. And I think this is a really money-making exercise. And the seller says, yeah, and I'll transfer this business to you for X amount, right? And then when you carry out the legal due diligence and you realize that there is only 1 year, or there already is a judgment or a claim against that company, then that will help you to say, okay, I will still buy it because I think it's still a good business, but I will reduce the price by X. So that's how then it all works out. Once you do the SPA, in the SPA, there's always a roadmap. You don't give all cash straight away. It's sometimes in installments, sometimes in a period. So then you go on the fourth step, which is the completion, which is actually when the shares are transferred, funds are paid. Again, lawyers are quite useful. They should be at that time as well, because that is when they will supervise the changing of the constitutional documents of the company. So, when you actually do the transaction, there has to be change in the trade license of the company, the name of the shareholder has to change, the memorandum of articles has to change. So these are the 4 steps which are involved in a typical MOU, in a typical, let's say, simple vanilla merger and or acquisition, right? That's what you would look at.
So you mentioned a lot about protecting the seller. Protecting the buyer. Does the seller need a lot of protection as well, or is it generally the buyer that's at more risk?
Well, buyer is at more risk, right? But then you see, like when we do the sellers, we'll try to protect the sellers as well. Okay, so we have advised before sellers as well on transactions, and what happens is the buyer's lawyers will say, "Oh, well, we have this indemnity," because sometimes people what buyers do. Okay, now this is I told you there are 4 steps: MOU, due diligence, SPA, and completion. Now, what people try to do is let go of the due diligence because that's quite an expensive exercise, tedious exercise. So the buyers would say, "Okay, I'll buy the company."
Okay,
right? But if anything happens, if anything goes wrong, you're going to pay me X amount of money, right? For if anything goes wrong in the next 3 years, right? Now, the seller, once he sells his company, he wants to go. He wants to walk away and, go in the sunset and enjoy his retirement and
Absolutely.
the money, right? He does not want the stress of like a potential liability that could come up for any reason in the next 3 years, right? And all the money that he made by selling may be used up for that. So again, at that time, we will be protecting the sellers. We'll say, no, we'll ask them to, what we will do is we will encourage the sellers, like, hey, if there are certain issues, genuine issues in the company, then you should disclose them right now. And those issues should be mentioned in the SPA, and that should be addressed. So that as much as possible, the day you transfer your shares, you walk away. You don't have to give indemnities later on. So, obviously, there's a lot more on both sides, but you can, you understand what I'm trying to say over here.
Yeah.
How both sides require lawyers to protect from their perspective, their positions.
So it is mostly, lawyers are pretty much running these transactions. They're the ones that are protecting their parties or their clients. And obviously, as the more complex it gets, the more parties get involved, financiers and all that sort of stuff. But ultimately, if you didn't involve a lawyer, could you do it? Could you make a transaction happen?
Well, people do, but then it potentially could be a big disaster, right? What if you buy a company and there's a huge case and you never knew about it? Right.
Yeah.
You need a lawyer to go out and carry a search in the courts, right? It's not like any layman would go into the courts and say, "Hi, can you please tell me if there's a case there?"
Yeah, absolutely.
Volunteer. It's not. You have to have the systems and you have to have the access and where to apply, how to do it to get. So that's a major issue. So you should, obviously people do it, and obviously there's some very small transactions. Obviously the SME sector. It's going through, and people are doing it because the legal costs cannot be justified, unfortunately. Yeah. And then they take the risk. But when you come to a new jurisdiction like UAE, and you have a very complex jurisdiction, because it's not like, let's say it's Australia, generally the laws are pretty much same all over, right? Here, within Dubai itself, you may have very different laws, depending which free zone you're in, which area you're in. So what if you didn't take the right permit and some authority came in and then, started to, penalize you for it? So it's quite risky.
Yeah, huge risk involved.
Yeah, huge risk, yeah.
Okay, so then what should really buyers do to approach due diligence effectively?
Firstly, once you've signed the non-binding MOU and all those things, then what the buyers do is they request all documents. It's the sellers who should present all their documents, right? And the sellers' lawyers usually tend to help the sellers for that. Create a data room where they'll have, in different sections, you'll have employment contracts, commercial contracts, loan agreements, litigation cases, various things, permits, licenses, different folders ready for the buyer's lawyers to review. That's how ideally should work. Now, sometimes buyers' lawyers are from a different country. So, I've seen like people from European countries, but they're using their European lawyers to help with the due diligence. Now, those European lawyers may require some assistance in terms of reviewing those documents. Assistance terms, they may have some questions. If they don't hire their own local lawyers over here in UAE, then they may have questions where the seller's lawyers should ideally answer their questions in terms of, what the law is to the best of their ability.
So I always, thought that the principles of M&A are pretty much global, and it doesn't really matter what jurisdiction you're doing it in. The same 4 steps apply. But it sounds to me like you're saying there are peculiarities, for example, in the UAE, in different jurisdictions within the UAE, that really means probably a locally based or someone who really understands the UAE laws and regulations is quite vital.
Yeah. I mean, so for example, like, this international transaction I'm telling you about, right? There's an English law firm that is supervising throughout the world all the due diligence, but they're dealing with local counsel in different jurisdictions because you need that input. So yes, it's working hand in hand. They are doing what you would call, like, let's say, the global principles. For example, at the end of the day, if a contract is bad, you can kind of figure that out, right? Whichever jurisdiction you are. Those kind of there are certain kind of those kind of commercial contracts. Certain loan agreements might be, usually a lot of loans and agreements are under English law anyway, banking agreements. So they would be able to do it. But then there are certain issues like lease agreements, right? Licenses, are they valid? Cases, what's going to happen, or the procedures. That's very complex, right? So, and like I said, there's a difference within Dubai. There's a difference in your land rental laws or tenancy laws between Dubai mainland and DIFC, for example, right? And they're different. If you are purchasing a business in DIFC, there are different things that you need to consider as compared to if you're purchasing a business in Dubai mainland. Yeah. So you have to have local knowledge of various areas.
So, yeah, I guess there are peculiarities to law even amongst the different emirates. You mentioned earlier that even Dubai and DIFC have different rules. So you must need to, I guess, get Dubai counsel that understands that. And then there's different rules in Sharjah, Abu Dhabi. Tell us a bit more about some of these peculiarities and the sort of advice you need.
Yeah, so Sharjah rental laws are different to Dubai rental laws. Dubai mainland rental laws are different to DIC rental laws, right? Now, I'll give you an example. You're probably aware in Dubai, you can, even if the tenancy contract expires, you cannot evict a tenant unless there are certain conditions under the Dubai rental laws, right? The Dubai tenancy law. For example, even if the contract expires, as long as the tenant is paying his rent, right, the contract will continue. And if you want to evict the tenant, you'll have to give a 12-month notice stating that you intend to sell the property or you intend to use it for personal use. And there are other ways as well to evict someone, right? In DIC, that does not apply, rental laws. In DIC, once the contract expires, you can terminate. Okay? That's the reason. Now, practically, let's say for an MOU example, and this is an example, right? If you purchase a business that has an outlets in shopping malls in Dubai mainland, right? Even if the lease agreements in the mainland shopping malls sometimes say that, you need permission from the landlord before there's a change of ownership, right? Even if you don't take that, the landlords cannot technically evict you on that ground.
Okay.
Right? Because that's not the criteria under the Dubai rental laws. However, if you're buying a business that has outlets in DIFC, right? And in the DIFC lease contract, they have a provision where where it's written that if you don't take permission from the landlord for change of ownership, right, this would be taken as a serious event of default, and we can immediately terminate you, right? That will be enforced by DIC courts. So you can see that, so if a buyer makes that mistake of not seeking the permission, right, he still is managed to survive in Dubai mainland, but his outlet for which he paid for the lease gets terminated. And what he paid for, the running business, and he's going to suffer a huge loss. Now you can see within the same emirate how the different laws can have a huge different impact on the business. So it's very important to seek legal counsel.
Absolutely. And I guess if you are the seller, for example, do you really need to is a part of the due diligence and part of it making sure that the other side has adequate advice as well to protect yourself? Or is it really their problem?
They have to do their part.
Yeah.
All right. They have to do their part in terms of clearly showing whatever the issues they have and clearly disclosing it. Right. So you usually have a disclosure letter, right, where all these issues are mentioned, and it should be attached to the SPA in order to protect the seller. So as long as the seller does that, it doesn't matter if the buyer had a lawyer or not, because seller has done his bit, right? So that's I would say. But on a practical level, right, you need lawyers of the buyer to push the seller a little bit as well, right? Life in real life, it doesn't really work in terms of one party will be completely open or will take the initiative. It's not like they're fraudsters, but take the initiative. Sometimes people are just a bit lazy about these things, right? So you need a little bit of pull from the other side as well. So it's good for the buyer to have the lawyers.
Try and get the deal over the line. Okay. Again, go back to basics. Could you explain the difference between a share and asset purchases in practice?
Okay. So a share purchase is that you have a company, like let's take our example, who has restaurants, or a company that has shops, or a company that has runs an IT consultancy, right? Rather than purchasing individual assets of the company, like, whatever they may have, like the inventory of a shop or something, right? They simply go ahead and purchase the shares of the company. So they buy the shares from the owner of the company, and then they become the 100% owner of the company, the buyer. Right, so that's a share. That's why you would call it a share purchase agreement, and that's how that acquisition is taking place. Right, so that's the typical one. Right? The other one is that there is a company that has quite a few buildings, like a developer has a few, an owner developer. He has a few buildings which he is running like a business. For example, they are all rented out. All the units are rented out, and it's a business in terms of he gets rental value. Right, another company comes in. Right. And they don't want to purchase all the other buildings of this company. So they're not interested in buying the company and, nor do they have the funds for it. They're interested in one particular building.
An asset. Okay.
The asset. So they will then go and purchase that asset. Now that asset itself will require due diligence, right? So both legal and financial. The financial guys, the accountants will come in and then they'll check the books, how much rent is coming, what are the expenses, the maintenance, and all those kind of things. The legal guys will come in and they will check, well, all of the tenancy contracts are correct as per required. Everyone has got a JARI. How many rental cases are there in the RDC right now? Are there any claims by tenants? Are there any issues with your maintenance? Because you may have been outsourcing your maintenance. So are those agreements tight and all in place? So those kind of things you would look at. And so that's be the due diligence for that asset. And then the asset would be sold.
So you've covered some of the sort of danger points, I guess there, or the things we need to be, the buyer beware. What's that saying? Buyer beware. What other approvals or disclosures that often catch buyers off guard? Or lack of disclosure, I suppose.
Well, look, I mean, just on this point, right? Sometimes asset purchases, I just want to link it to the previous question. Asset purchases, you have to be a lot more careful in how the asset is actually transferred, okay? Because sometimes in terms of procedurally, it's easier to do a share purchase. So for example, take the building example, right? The building example is if the company just had that one building, which I wanted, for example, it would be way easier that if I just purchase the shares of the company and become the owner. Procedurally, that's easy, right? Very clean. But now let's say the example that we were talking about, that there's several companies and we just want to buy several buildings owned by the company and we just want to buy one building. Then what you have to do is also that, okay, so now the building has been transferred. So the ownership of the building has to be transferred by title deed and all that. But the important thing is that eventually the tenancy contracts also have to be transferred as and when they are expiring, and you have to make sure that the new tenancy contracts are then in the name of the new buyer, so there might be 200 or 300 tenants in that building.
Wow.
Right.
Yes.
And so you have to keep and then you've got to make sure, for example, the complications that those tenants may have paid a security deposit to the previous owner. And when they're leaving, so how's that security deposit going to be dealt with? Right, that's going to be transferred to me, the buyer, or they're going to take it, and is that going to be reducing the price? So you can understand that there are lots of complications coming out when you're buying the asset with the building.
So how do you deal with those then? What do you put in place to make that as practically as easily as possible, as easy as possible?
You have to, first it's all about planning, right? Firstly, you have to sit down, think about the transaction, and then think about all the things that are related, what can go wrong, security deposit, you have to think, and then it's a teamwork as well. So I'm a lawyer, so I've got because we've been involved with transactions before, and, just being so many years in the practice, you kind of already know the things to look out for example, right? But the accountants, they are also professionals. They've been in transactions, so they will also feed you with some information, right? Oh yeah, in our practice, these things also happen. And then the owners of the businesses themselves, right? Like usually the people who are going to buy the building also are, already property owners. So they know what needs to, so you have to brainstorm that what are the various elements that you have to address and think about in this transaction. And then you have to come up with a plan, right? So this, and then you have to see, okay, so therefore due diligence would require to look at all these things. And then how this will be structured in an asset purchase agreement, how that will all be included, and how it will be transferred. Will the security deposit move or not move, or will it do it therefore? Then it becomes a big exercise. So it takes takes some time and a lot of effort as well. So that's all I can say. That it's a lot of experience. And it's all teamwork as well, because everybody else in the team who comes in, be it the buyer, your client, and the other advisors, they have their own experiences as well.
So who else is part of the team then? You've got the lawyers and the accountants. Who else do you need to actually get on your team?
The consultants, the business consultants, who initially gave the idea to the buyer to purchase this. It could be the bankers as well, if they're financing a purchase sometimes. And the buyer himself would have a team usually, because the buyer, it's not like I'd say high net worth individuals, but obviously they've had companies and they have teams already.
Yes.
To talk about it, right? So, for example, I'll give you an interesting example. Like, I didn't know this, right? So there was like a small salon that was being acquired by like a client of ours, right? And so that was a small deal. But, sometimes people want to buy a salon or something like that, right? And it was the accountant who told me, oh yeah, we worked on another acquisition like that. You've got to be understanding that it's a very cash transaction, and the seats are actually rented out. The barbers are not actually the employees; they're actually on a commission based,
right?
And the seats are rented out to them, individual seats, on service salons. Yeah, not all of them, but some are run like more professionally. Some are run like this, like a business. So the buyer, he doesn't want to pay the salary of the barber, and he says, well, this is it. We will rent this chair out to you, whatever clients you give. Either you give us a commission, and you take a certain portion, and that's how it. So I didn't know this, right? Now, when you have a situation like that, then you have to make the buyer aware, right? So what kind of agreements do they have with these kind of barbers, right? Now there's an issue start off, right? Is this going to be illegal as well or not, right? Is it enforceable or not, right? They've entered into these arrangements which have never not been probably tested on the court. Are these guys employees on paper? If they're not, what are they? Are they commissioned? Can they do work like that? or when you purchase the salon, you'll start like suddenly tomorrow somebody from More, the Ministry of Labor, comes in and slaps a fine on you. Like, why is this guy working if he's not on your visa, for example? So there are quite a few things that you have to think in the M&As. But that's the beautiful thing about it, right? Every time you do a transaction, you learn about the business as well a little
Right,
bit. And then your knowledge bank keeps increasing and your experience keeps increasing.
So I want to turn a bit more to then, we've talked a lot about the mechanics of an M&A deal. Mm-hmm. What about, in order to ensure a deal goes as smoothly as possible, what kind of planning needs to be done in advance? So I want to think about the seller first. So if you as a business owner or someone in the C-suite are thinking, okay, we want to sell this business in 2 years' time. From your perspective as a lawyer, the one who's pretty much going to run the deal, what do you want to see in place from that business for when it's time to press go and sign the non-binding MOU and get the due diligence underway? What do businesses need to do to prepare?
Right. So this, what you're talking about, is a very ideal scenario, right?
Yeah.
I think a lot of times you don't get that time. The buyer, your seller wants to straight away do it. You sometimes come on in the middle of a stage or whatnot. But in a very ideal scenario, let's say a seller wanted to sell his business, right? I would then sit down with the seller. Firstly, ask the seller, what kind of issues the company already has, right? And the seller could be honest with us and all those kind of things. And then, so that I'll keep in mind, because later on we will eventually advise the seller, you have to frankly disclose this to the buyer, right? And then the buyer, as part of their due diligence exercise. And then it'll be up to the buyer whether he still wants to buy it or whether he wants to then take a discount on the price.
Okay.
Right? Or whether he will still pay the full price, but then he'll want an indemnity from you, for example. Right? So there are various options that could happen, but you need to frankly disclose it to the buyer. Then also what we would do is we would help the buyer to create a data room, right? Where the seller, the data room, right? So we will say, okay, provide all your employment contracts. We will review it, right? Make sure that they're all in order, everything, put it in the employment folder, put the commercial contracts, commercial, loans, licenses and everything. We'll check, litigation, check and everything. We will also probably carry out an extra check on the litigation from the courts ourselves to make sure that there are no cases that even the seller didn't know about, because that could happen, right? So that's all on board, above board and everything. And then we'll help. And then once we prepare, the other buyer sides come in. And when they start sending out their queries, questions about that, we will discuss with the seller and discuss and everything. If we need his input. Otherwise, if it's something regarding something about just the UAE law, if the other side doesn't know about it, for example, they're lawyers, foreign lawyers, then we will explain them from our perspective as well. So in those ways, we will help. And then all the other documents, we will then structure as much as we can to have a fair agreement, but the buyer should be protected at the same time. Because at the end of the day, the lawyer's job is not just to protect his side. The lawyer's job is to facilitate a transaction, get the deal done as well, right? So it has to be fair as well at the same time.
So, okay, so that all makes sense. So from what you've just been saying, you're actually generally not involved in the transaction well in advance. You don't generally get your ongoing clients coming to you a couple of years in advance saying, look, I'm working towards making my business, sale ready, basically. What do I need to do, Samir? They're not planning that far in advance, you're finding, and you're not able to prepare them.
Actually, no, it depends on the client, right? It depends.
Yeah.
Some of the most sophisticated companies, for example, one company that we are doing did a due diligence recently, right? Is finished just recently. That company actually, it was interesting, made us it was a seller who did a due diligence. Without the seller was carrying out appointed lawyers to do the due diligence, to create a report. So that could be shown to a potential purchaser.
Yes.
Well.
That was my question, I guess, is what do I need if I know I want to sell my business in a couple of years, what do I need to do to make it sale ready, to make it easy as possible?
Exactly. Not only to potentially purchase them, but sometimes you want like large loans from banks, right? Investments, sometimes for investors, right? Private equity is like, so you already have it ready. Now those others may want to do it themselves as well, or sometimes they don't. Sometimes they will just rely on their report, and then they will mention that in the SPA that we are relying on your report. For example.
So what do I need to do then? What are the steps I need to take to make my business sale ready?
If that's the other thing, then what you need to do is you need to talk to two people, accountants and lawyers. Accountants will say, okay, you need to have proper audited accounts for at least 3 years.
Okay.
Preferably 5, but at least 3 years, right? Have everything ready. So it's all clear accounts, and whatever revenue your companies be generating, it's clear. And it's ideally, it's not cash coming in, right? It's actually bank-to-bank transfers. You're getting money and you're paying tax on it and everything. So it's that credibility, right? Then before even the due diligence, we could, like lawyers could advise you, yeah, maybe you may want to go to a particular free zone, which is more reputable for among international investors, because they may have, like, for example, DIC is quite reputable. ADGM is quite reputable because they have English courts, and investors like that. They are more sophisticated courts. So it's sometimes good to incorporate a company in those fees, even though they're more expensive. It may be better to do so because investors may find more comfort that, yeah, if something goes wrong, I've got English style courts, English law based courts to go to, maybe. And the other thing is that if you have any issues, underlying issues already, let's say you have cases and this, say, well, why don't we just wrap this up? Try to get some settlements, try to clear that up. There are quite a few things. And then we can even, say, okay, let's prepare a due diligence report.
Perfect. So yeah, I think that would make a sale much, much easier. On the flip side, what about buyers? What do buyers, what can they do as far as in advance to make the transaction as quick and efficient as possible?
What the buyers need to do is they need to understand that the delays happen is because buyers, they first don't want to spend money on advisors to advise them on the deal. They go ahead a little bit step, then they find some issue that scares them a little bit. Then they get people involved, and then the whole due diligence starts. So I think it's best that for buyers, you have to come to a certain conclusion that, look, I am buying this company, X amount will be spent on advisors of the funds that I have, the budget I have, right? And those advisors will first plan it out, right? Say, okay, we have to do this. We have to look at a lot of these brainstorm elements, plan it. These are the issues that potentially could happen with this kind of sector. And we need to go and do a due diligence on the whole thing. And it will take us this long because, plan it before. And this should be mentioned in the, this is the approach that you should take. So transaction will take time, but it's the best way to do it, and it's the fastest way within that process.
So basically, preparation is everything. You
Everything.
just need to get all your ducks in a row as much as possible, have the right advisors, accountants, lawyers to have done, regardless of which side you're on, buyer or seller. So what common mistakes do you really see from both sides, and how can you avoid these?
Well, it's this, right? Lack of planning, right? So lack of planning, due diligence, not taking the, pretty much saying, oh, we've got an internal accountant, just send over your audited reports. We take a look, we know what it is and everything, but not carrying out a detailed due diligence. People underestimate that a lot, unfortunately, a lot. And it's not only with acquisition of companies, it could be acquisition of properties sometimes, right? Major properties. You should prepare a lot. In fact, like, for example, we were assisting someone to purchase a plot of land so they can make a building on it. They want to become a developer and everything. But initially they did a very basic due diligence, which was just asking around people what is required, what happens and all that. But in any business, any acquisition of business or doing any business or making any investment, the more you prepare, the better you are. The better you will be. It's all about preparation.
Prior preparation prevents poor performance. Did I get that right? I think I did. The 5 Ps. And I think as from the seller side, it sounds like the things you really need to do is just make sure you've got all your ducks in a row. Make sure that you've got minimal liabilities, that you haven't got claims against your company or your business or your asset, that your company's sale ready, basically, or your assets are sale ready.
Yeah, and you should be open about the major issues right off the bat, right? Because sooner or later, the other sides are going to find out in the due diligence process. And then why stop the transaction after all that effort and time, right? So the major ones, you should be straight off, look, this is the issue. Yeah, we've got a 20 million dirham claim. It's in the court. Letting you know now.
Be honest.
Letting you be honest, right? I don't know how it's going to go. Well, that's what it is. Now, you still want to buy us?
Fair enough. Well, that's all been really interesting, Samir, and a really good basic guide to those of us who don't do M&A day in, day out. And I'm hoping one day we're able to get involved, whether it's buying or selling a company. We're all fortunate enough to do that. And obviously we'll all come to a good lawyer like yourself. So if people do want to find you or do need help with guidance, how can they find you and get in touch?
We've got our website, www.sklegalfirm.com.
Yep.
And our contact details are there. And you can also email us directly at info@sklegalfirm.com. And then we'll get in touch.
Brilliant. Well, thank you very much, Samir, Managing Partner of SK Legal. Thank you so much for joining us today on Muhami Matters, sharing the practical insights, giving us all some really good tips.
Thank you, Chris, for inviting me. Really enjoyed it.
And if you want more tips and things and some great articles written by Samir, you can visit his website. You could also visit Muhami.ae. Samir is a regular contributor there, and there are some amazing gold nuggets of information on there. So keep an eye out for that. So again, thanks again to Samir for joining us today. You can get in touch with him via his website, via Muhami. We'd love you if you subscribe and visit Muhami.ae, connect with us at CJA Consulting. If you're listening and eyeing a business deal, check out those articles like I mentioned. That's it for this episode of Muhami Matters. If you enjoyed today's conversation, be sure to subscribe, share it with your network. As I said, for more insights and support, visit Muhami.ae, connect with me, Chris Adams from CJA Consulting. Until next time, stay informed, stay empowered, and I wish you all the best luck on your deals. Thank you for joining us on Muhami Matters. If you found today's episode valuable, subscribe and connect with me to stay updated. Join me again soon as we continue to bring you credible insights, practical strategies, and trusted advice to empower your professional journey. I'm Chris Adams. Until next time, stay informed and stay empowered.